The stock market's crashing. Ah! Wait. Total stock market index is down 5%. That's not a stock market crash. There's barely even a correction. What's going on? What's going on is that it's not the entire stock market that's collapsing. It's actually segments of the market. It's the richly valued, I'm going to call them hype stocks, that have been making its way in the news so much over the recent time. Like Tesla, Workhorse, Palantir, Beyond Meat, Churchill Capital, and so many other ones just like those ones. So what I wanted to share with you are 4 investments that I see are thriving in this environment and some that I believe are poised to make you massive gains going forward. So welcome back to this 6th ever episode of our stock journey to teach people opportunity cost investing and how to calculate and communicate their performances. I'm Jesse, these are our returns so far, this is what our portfolio looks like, and the proof is in the description. But let's get into this video, starting with our first investment idea, and that is Berkshire Hathaway. Berkshire Hathaway is the company and legacy of Warren Buffett, the world's 6th wealthiest person and the world's greatest investor to ever live. So what stock did the world's greatest investor purchase the most of in 2020 and 2021? Is actually his own company, Berkshire Hathaway. In his annual letter that he disclosed recently, he said that he purchased $25 billion of the company, which is about 5%, and he had plans to continue that going forward. And it's kind of funny to see because he also disclosed a $9 billion purchase in Verizon that I believe is just a cash substitute. But you saw the Verizon stock shoot way up, but Berkshire Hathaway, it still trades at the same multiple. But anyway, I'm getting into the weeds. What is a share repurchase? Well, a share repurchase is when a company buys its own stock. And just like when a company buys its own stock, and just like how you buy a stock, you want that stock to be undervalued. So essentially what Warren Buffett's saying is that he believes his stock is undervalued. And I believe it is too. Share repurchases or share buybacks are kind of like a tax-efficient dividend. It's very similar to how anytime I post a video, I like my own video, so YouTube pushes out to more people who will also like the video. So I think it's a really good sign that the person that's the best investor and the person who knows Berkshire Hathaway the best is purchasing shares in the company. However, that doesn't necessarily mean he's right every single time, so let's do some math, and I'm going to do it as easy as I can for everyone to understand it. So if you buy Berkshire Hathaway, you're buying it at a $550 billion market cap. What are you getting when you purchase shares in that company? Well, you're going to get $150 billion in cash, $150 billion in his other businesses like BNSF, which is his railroad company, BHE, which is his energy company, and a whole slew of other businesses that he congregates together. And then you have $250 billion that are in stocks. The $150 billion in cash doesn't really bother me too much because if you can make great gains without it, then who cares? Or if the market crashes, that'll give him great leverage to purchase acquisitions or invest in stocks that he think are undervalued. Now the $250 billion in stocks, about 2/3 of that is weighted towards Apple and Bank of America, which have vastly outperformed the index and I believe are going to continue to do that. If not, I mean, they've done so well so far that a little bit of turbulence might not hurt the overall performance. Overall, I'm not too concerned about the stocks that he has, especially because it's more liquid than, say, businesses. So really what we're concerned about is whether the $150 billion valuation for those other companies are really worth it, because I'm not too concerned with the stocks and the cash. So how do we look at that? Well, one thing that I would like to do is look at the price multiple, and I'll explain that really easy. Essentially, that $150 billion in companies makes, according to his annual letter, $20 billion in operating earnings. And after taxes, we'll call it $15 billion. So you're paying $150 billion for companies that make $15 billion after tax, roughly. So that is a 10 times earnings multiple. Is that high or is that low? Well, consider this. The market average right now across all companies is about 20, and historically it's been 15. So I think it's pretty safe to say that it is undervalued. And if that's not enough for you, consider the fact if you look at the price to book ratio, it's roughly 1.2, 1.3, which is about where Buffett said in the past he likes to repurchase shares. And if that's not enough for you, the PE ratio, which is the price to earnings ratio, is roughly 15, which is historically pretty average. However, the market average currently is 20, so it's undervalued under our circumstances. However, purchasing shares in Berkshire Hathaway comes with a CAT risk, or catastrophe risk. And that is the risk of Buffett or Munger or both dying because they're getting really old. So instead of purchasing as many shares as I would like to in Berkshire Hathaway, I'm actually scaling it down a bit. And that's just in case that scenario does happen, because I do believe that if Buffett or Munger or both were to die, it is very likely that the stock could go down. However, I want to reiterate, I believe that the company is undervalued now. And if it were to crater because one of the two or both would die, then I think that gives you a better opportunity to purchase at lower prices. So I'm going to scale down my purchases and keep more money on the side just in case that were to happen. Then I can pile the money into that once in a lifetime opportunity. But again, that's kind of a low event and it's only a probability and has nothing to really do about the business, but it needs to be said. The next investment idea I have is cash. And I know that sounds like a cop-out, but hear me out. I believe that there's some truth to this market sus. Following along with this Buffett theme, the Buffett indicator, which is what Buffett said is roughly a metric of how he feels about the market at any given time, is barreling off the charts to levels that we've never seen, even at a time right before the dot-com bubble crash. On top of that, I was also reading the very last couple paragraphs of Warren Buffett in the interpretation of financial statements, where they suggested that if the S&P 500 reaches about 40 for PE ratio, it is high time to sell. Currently, it is 39, which is close enough for me to be spooked. And I know traditional thinking would say, but Jesse, interest rates are real low and we should expect and accept higher PE ratios. And that's only half true. Yes, PE ratios will be higher just like we've seen, but we shouldn't accept them. Let me quote famed value investor Li Lu, who said, "The low interest rate environment, 1, is usually temporary, and 2, should be seen as a warning sign as it does not prevent the economy going further south. In this environment, one should set their margin of safety requirement to be a lot higher, not lower." And I know that was maybe a little confusing, so let me try to quote Howard Marks, another famous value investor, who put it in a really nice and easy to understand way. What Howard Marks showed us in a previous memo is this risk-reward chart, which is vaguely correct, but that's for another video. What he showed us in this memo is that when interest rates drop, so too do the expected returns of all other securities. In plain English, what that means is, if the rate of return on the risk-free security goes down, then all other securities will also have their expected returns go down because everything's relational. They don't have to be as competitive with higher rates. They can be lower. So what Howard Marks is saying here is we'll see higher PE ratios because a PE ratio is nothing but 1 divided by the expected return. So let's put you in the hot seat right now. Let's pretend you're investing in companies that were fundamentally strong balance sheets and everything, and we're giving you a 10% return on your money. Then interest rates dropped. Those same fundamentally strong companies don't have to give you a 10% return. Instead, they can give you 8 or 7% because they're still competitive with what's called the risk-free return. You then have two choices. Do you stick with the same asset class you're in and accept a lower return? Or do you move up what Howard Marks calls equilibrium into the riskier category to maintain your 10% return? What I believe we've seen in this market, and from the people who claim that there's a market crash right now, is they've moved up the equilibrium to maintain the same rate of return, which is why they're experiencing all this volatility and they're being shown what a riskier asset really means. And I think it's actually going to continue. But I digress. Howard Marks at the end of his memo concludes by saying that we should proceed with caution, mirroring what Li Lu said. When we hear proceed with caution and increasing your margin of safety, what does that mean? Well, to me, it means increasing your cash position and really focusing on the fundamentals of a business. And it doesn't have to be cash per se. It could be US Treasury bills, or it could be companies that provide a large dividend. So that way, if the market goes down, you have all the dividend cash that you received that you can pile in the companies at a discount. Which is why I believe we've seen Berkshire Hathaway purchase small positions in Chevron and Verizon. Now, after all, this is a stock portfolio update where we teach people calculating and communicating performances. So there has to be some kind of lesson in that. And talking about cash as an investment idea is the perfect segue to talk about how brokerages don't include the non-invested cash that sits idle in your brokerage. The brokerage rates of return, no matter what brokerage you're using, only includes the invested cash. So if you have anything sat idle, it'll make you think you're a better investor than you actually are. And it's something I want to talk about more in an M1 Finance video that I'm going to be releasing in the future. But for now, that's all you need to know. So my next investment idea goes out to all those indexers out there, and that is the Vanguard Financials Index ETF, or VFH. And I know with a lot of Vanguard ETFs like VOO, we give it a name like VOO, but I can't do it with this. So I'm going to call it the Vanguard Financials Index. But anyway, this ETF I think is poised for massive gains because if you look at the top 40% of its holdings, it's weighted towards some massive heavy hitters like JP Morgan, Bank of America, Citigroup, Berkshire Hathaway, and so many others. I've looked into each of these companies individually and I really like them. So in terms of an ETF that I think is going to outperform, it would have to be this one for sure. Although the expense ratio is a little higher than something like VOO at 0.1%, I think that with a PE ratio of about 10 and a dividend ratio of about 2 and a collection of companies that I've looked into and I really like, this one is almost certain to outperform. So I'm guessing none of you were super shocked to find out that the Financials Index ranks among one of my best recommendations. Especially because if you look at our portfolio allocation, you can see that Bank of America and Ally Bank take up the vast majority of our portfolio, just in those two stocks alone. But if I were to recommend one stock that's going to be a knockout performer among the Financials Index that is not Bank of America, Ally Bank, or even Berkshire Hathaway like we talked about before, it would be our fourth investment idea, Hingham Institution for Savings, or HIFS, which is the ticker symbol, and I'm just going to call it HIFS to keep it fun and lighthearted. HIFS is actually an idea I borrowed from Adam J. Mead over the Oracle's Classroom, which is linked in the description below. But ever since I found out about this company, I've been doing some major research into the company and have been blown away with the fundamentals. If you look, you can find net charge-offs of virtually zero. I mean, you can keep looking, but you'll never find them. And then they have loan loss provision ratios that are ranking among one of the best in the entire industry. Although they have a price to book ratio of 2 and their loan to deposits are a little higher than I would like, I think it's warranted because they have a return on equity that's been 15% for years. And they have steadily and increasing earnings per share. And on top of that, they're largely insider owned. On another negative note, they have some expansionary costs that are coming up. But to combat that, they also have a PE ratio of about 11, I'm going to say 12. And so many other good things that I've seen about the company, especially the one where they've noted they're super focused on what they do. Overall, I think Hingham Institution for Savings is a likely knockout outperformer. In fact, so much so that it's been outperforming my Bank of America and Ally Bank. And I haven't fully decided to invest in HIFS yet, but I'll continue to do the opportunity cost and cry in a corner when I show to myself over time continually that they're outperforming my picks. And if you made it this far in the video, I really appreciate your support and thank you so much for making it so far. If you wouldn't mind just subscribing to the channel, it helps out the channel tremendously. And don't worry, you're not going to be hit with notifications from YouTube up to wazoo or anything like that. It's just a way to show your support to the channel. Also, as a reminder, I'm not a financial advisor and this isn't financial advice. Always make sure to please do your research and please hold me accountable. Make sure to take my recommendations and check and see how they turned out 5 and 10 years from now. So that way you always know you're getting your information from someone who's actually performing. And that's a huge part of opportunity cost investing, right? But I think that's all I have for you today. So make sure to check out my portfolio holdings in the description below because I do own some of the securities we talked about today. And I want to make that clear because sometimes they can be good or sometimes they can be bad. And I'm really trying to do something good here. I don't usually talk about stocks and why I hold them and why I buy them, but I felt this high level video gave me an opportunity to talk about things like cash drag, risk reward, and kind of the market environment we're in, as they all kind of tie together and gave me a great opportunity to talk about the things I did. But that's all I have for you in this video. So if you found the content helpful, make sure you like that smash button by stock in our subscriber count and Liberty Bell, that notification icon. Thanks for watching, and until next time.